So if you're not using the following indicators, you'll be making a big mistake if you plan on investing in 24 and 25. Hey everybody, Greg Barron, aka Professor of Real Estate. Thanks for joining me today on the channel. We've got some information today to talk to you about where to invest in the coming real estate crash of 2024 and into 2025. I get asked a lot, what are you doing, Greg, to prepare yourself and where are you going to go? And we take a very analytical approach to it. Believe it or not, and people that know me, I tend to brood over things and I use a lot of charts. I use a lot of data. Obviously, I use a software system that we've developed to try to determine what's going to be the best market, the best return, and it all starts with people. And sometimes you ask, well, what does that mean? It starts with people. Well, anytime you're looking at real estate, it always starts with people. Whether you're doing multifamily, retail, industrial, whatever asset class, commercial, you got to have people to be able to utilize the facilities that you're developing or you're investing in, acquiring, or sometimes disposing of. So when I start this conversation, I always start to talk about the demand, and that demand goes back to where are people migrating from. So unless you've been hiding under a rock for the past few years, you've heard a lot in the news about migration patterns. Now, not to over politicize where I'm going next, but we all know that some areas demographically and geographically have been in the news on a daily basis. So luckily, for those of us that are in the real estate space, there's a tremendous amount of information, charts, data, graphs to help us analyze to make great decisions. One chart in particular that shows these migration patterns, it really tells a story of what's happening universally across the United States. And as you'll see from the graph that I'm going to throw up on the screen, there's been a tremendous amount of migration into what we call hotspots. And I like to call a lot of these triangular areas because they happen between three major cities in many cases. Take a look at the graph that I'm going to show you, and you'll see that a lot of the deep red areas that are shown are areas where you have the hottest migration trends, especially in the last 5 years. Now, I'll draw your attention to California. California is all non-significant or neutral white. There's been an exodus out of these areas along with Chicago and along with some parts of the Northeast. You'll notice also, and if you've been reading the news, you'll know this for sure, that those southern states are the areas that have picked up the net migration trends as far as the incremental increase in population. You know, between Dallas, Austin, and Houston, that's called the Texas Triangle. Up at Nashville, over to Charlotte, and down to Atlanta, there's been a tremendous amount of migration in those major cities. And then, of course, we've heard a lot about northern Florida from Jacksonville down to Miami Beach, which has also been a heavy migration trend. So you can pick up these migration patterns, and that's the most important thing. Number one is to see where are people moving in mass, because you're going to have people to support your rent, and your rent is going to increase your revenue. Revenue is going to generate your NOI. Your NOI is going to be the thing that drives your valuation in the future. So migration patterns are the number one thing that you need to look at going into late 24 and into 25, because there's going to be some salient things that you're going to need to pay attention to, both in these micro areas and those sub areas within those triangulation areas that I've mentioned. So as you're looking at migration patterns, you'll say, well, there's opportunities in other places where the valuations have taken a nosedive, so there might be deals that be had. Well, I'm of the opinion that just because there's a deal in San Francisco, it doesn't mean that I want to go there, because we still got a net migration out of the city. Forgive me, all of you San Franciscoites that might be listening, but it's not really a place that I'm going to be looking, because even though the valuations are been suppressed or depressed, it doesn't mean that I'm going to run out there to do a quick deal. So what I am looking for is those areas which is my number 2 point, is where the demand is high and also the supply is high. So even though it might be oversupplied at this particular time, places like Austin, for example, right now, the rents are taking a nosedive because there's been an oversupply. And I'm going to get into a chart in just a second, but I'm going to show you why you really want to concentrate on those areas which are presently oversupplied and there's still a high demand. So remember that one critical statement: you want to be where demand is high still and it is oversupplied. So the next chart I'm going to show you is really to show you that the historic demand and the historic supply usually flows pretty much in alignment with each other. So let's pop into that just a second, and I'll show you. The light teal color is the U.S. quarterly demand, and the black is the U.S. quarterly supply. So you can see these variations that are shown, and I'll draw your attention to Q1 in 2021, where you had a tremendous demand in the following years and an undersupply, which created this need to bring new units on in that particular time frame. Now, one thing I do want to explain with the permit to supply is that if you're bringing on new supply, and this gets a little complicated, but from permit to the point it supplies the market, there's usually a 2 to 3 year lag period. So you're always playing a game of prediction to when you should bring this supply on board. And what tends to happen is the demand increases, syndicators and others come in and they start that supply chain process. There's a lag of 2 years, and by the time that it comes on board, you're oversupplied, which means there's a suppression in rents because there's more of it than there is demand, which creates a buyer's market. And I'm going to revisit that in just a second, because that particular point is essential in understanding the timing of the market. Now, this particular market that we're going into, late 24 and 25, for those of us who have seen these cycles happen over the last 20 years, understand that during that time of COVID, it fell off the map, but interest rates were low. There's a lot of projects that were still in the permitting process. They started construction, but they don't come on board as supply till 2 to 3 years later. Now, if that's confusing, and it probably is, I'll just point out that you've got to be a student of this cycle to understand when to pop in and when it's going to be the most advantageous to start acquiring this or developing new properties. And we're just about there. So let me talk to you about the correlation of this supply and demand versus absorption, because you can actually do some deep diving in the particular, those are hard words, in the particular geographic areas you're in to determine the timing of when you should start this acquisition cycle. So look at this multifamily absorption chart, and you'll see that the orange is the quarterly demand, the blue is the annual demand trailing 4 quarters, and the light green are the units under construction. And what I want to draw your attention to is you go through these spikes. For example, the quarterly demand rose in the second quarter of 21 as the annual demand started increasing. And remember the lead lag definition that I gave you. And also you'll see that the number of units started to spike during that period because a lot of people want to jump in and they should have already been in it, but that's not the nature. Back then, you still had rates that were reasonable, so everybody started projects, and this is multifamily, and to meet what they thought was a undersupply of the market. And then what happens? You'll see at this point right here where it peaks, the annual demand peaks, and also you still got this construction that is rising, and what happens? Well, it falls off right here, just falls off a cliff, and annual demand decreases, but yet you've got an oversupply. So I need you to remember that, because that's where we are entering right now as we speak. All those projects that were started 2 or 3 years ago when rates were still at rock bottom are now just coming on the market. So your demand is still strong in these markets, but you've got an oversupply of product, which is going to be great for the renter. It's going to suppress the rents. It's also going to reduce the valuations of those projects. And quite frankly, you're going to see valuations continue to fall off. And those of us that are in the market waiting, we're going to be looking at our chops, because that's going to be the one opportune time for us to jump in and make some really good deals. Now, I want to give you an example again of one submarket. This happens to be in Albuquerque. Now, I'm not picking on this. I just happened to study this chart a little bit to drive home what I'm trying to talk about: supply and demand and absorption equals opportunity. But let's take a look at this, because this is the same type of chart just on a micro level. And you'll notice in the first quarter of 21, you had this basic high occupancy, well over 97%. You also had a very high supply spike during that time, but it can't last forever, and it didn't. So what you found was you have an oversupply, you have a high demand, that supply met the demand, and then it just fell off a cliff. And then you have this lag period, probably where people were permitting. At this point, construction started again and finished. So at this point, at the very end, in the first quarter of 24, you have a very high supply, and which reduced your occupancy level. This market is specific to what I've been talking about. Right here, you will see that from this point forward, you will start to have failures. You will have multifamily units that will start giving their keys back. The valuations are going to go down, and this is the point where you want to be ready to acquire. This happens in every market. It's also going to happen in Austin. It's also going to happen in other parts of the country, Colorado Springs, other areas that were a little late to the game, that met the supply. Occupancy went down, it softened it, it became a renter's market. And I'll show you in just a second how you can really even look more where there's concessions and then where there's reductions in rents, but an oversupply, but the demand is still high. That's where your sweet spot is. That's where you want to be. But before we move specific to that, I want to show you one more chart that will drive home this fact even more. This is a national chart. This is put out by Real Page, which is great information, by the way. And it will show you overall from the second quarter of 94 all the way up to the first quarter of 24, the amount of units that came on board. And you'll see here at the very end where we circled it, the light green or teal color is all in the South. That's the greatest amount of movement because you had the greatest amount of migration. There's nothing bad about that. It's more favorable to business. People wanted to move to the South out of places like Chicago, San Francisco, the East Coast, and somewhere up Northeast. So you had all this activity that was shoved into supply, primarily in those southern markets. And I'm going to show you another chart in just a second of the 10 best and worst markets. But this is another indicator that in the first quarter of 24, this will give you an indication of the areas that you need to be looking for. Again, it's going to be mostly in those southern states where more supply was provided to meet the demand. And then it starts to suppress those rental rates and it starts to destroy that value, which gives opportunity. So let's move to the next chart. This next chart I'm going to put up will show you the annual supply as a percentage. And you'll notice that historically in the last few years, all the yellow place marks there are those areas where you had an incremental increase more than the rest of the country. And again, they're all in what I call the southern states, from Nashville over to the Virginias, down to Florida, over to Texas, and then into Arizona and into Las Vegas. There was some that were in Colorado, but those were lagging what all the southern states. had, and again, I'll bring your attention to the fact that these are the areas of the heaviest migration. So you have this migration, then you have people that need places for shade and shelter. So you supply it with that to meet the demand. And then once you meet that or oversupply it, then you suppress the rent rate that they're charging because there's more competition, which is where we are today. This last chart on income growth that I'll show you is what RealPage showed as the bottom 10 markets by gross income growth in 2024. And guess what? A lot of them are in what I call those Southern Belt states. Austin in particular, it's been in the news. It's had greater than 15% rent reduction. Also, Nashville is getting hammered just a little bit. And then there's some other submarkets like Seattle, Minneapolis, DC, and those others, where usually that migration was followed by the supply, it suppressed the rent, too much supply for the demand. These are the markets that are ripe for looking at in the year and the 2 years to come. So I've said all that to say that once you get to the point to where you understand where this migration is, where this oversupply is, where the supply and the demand are still high, and you've got a future outlook that's good, what you want to do at that point in time is you want to do a deeper dive to those geographic areas, and there's a really good tool to do that by. It's called realpage.com. And if you go to their Explore page, there's free analytics where you can type in any city and you can determine every unit, and this is in multifamily space, but this is just such invaluable information. Let me go back to the Albuquerque example. So with this particular website, you can actually pull up Albuquerque, and within this map, it will show you every multifamily unit, whether it's 25, 50, 400 units, and you can see and deep dive into if they are at a point where their rents are being suppressed and whether they're offering concessions. Let me show you what I'm talking about. And I'm just going to take a random sample here. I'm going to tab on this one right here in Quigley Park. Happens to be Uptown Square. I just press view, and then it pops up there. It shows me it's 122 units. The square footage when it was built, it's a B minus, and right now it's at 100% occupancy on all their studio units. Well, they've only got one, so I hope it's 100% occupied. And then they've got 66 units that are one bedrooms that are 97% occupied, and here is their effective rent that they're getting. Let's take another one, and let me see if I can come up with a different scenario. Right here, this is again in Albuquerque. This particular unit has a complex has 572 units, built in 1986. It's an A minus asset class. And we'll see here that it's got a multiple of studio, one bedroom, and two bedroom. This happens to be 93% occupied, 93%, and average 93% at an effective rent here. You'll also notice that this particular complex is not offering any concessions at this point in time. It's 93%, not bad in the Albuquerque market, but if you continue to look, or if you're looking at an acquisition, you could actually pull up RealPage and determine if this particular unit is one that is seen as suppression in its occupancy, and also if it's offering concessions, and if it's in that market where you've determined that the supply has exceeded the demand for that particular time. Again, you want somewhere where there is a demand for it, but you also want to be in an area where they're going to start giving concessions and you see a reduction in the rent rate. That's the opportune time to start looking at it, because you still want people. So you want occupancies to go down as a percentage, and you want to look for those concessions to start to increase. Those are certain ticklers that you want to watch out for when you're looking at numerous properties, whether it's a value add or a pure acquisition. So what are the takeaways from this particular video? The takeaways are that those of us who are watching it are waiting for those markets that have that abundance of supply, but still have great demand for the future. I'm looking at those particular areas that are primarily in the Sun Belt, but you can still apply these same methods, whether it's a smaller multifamily unit or a larger one. If you go into another asset class, you can utilize the same kind of methodology to determine where you are in that cycle. So here are the takeaways that I want to leave you with this video. Number one, population growth is the number one key. Number two, continue to look for those migration patterns into the areas that you want to invest in. Understand where the people are coming and where they want to live. Number three, look for the lead lag indicators for that particular market. Those lead lag indicators are everything that I mentioned before. Pull up your permits and those that are under construction. See what the absorption is. Use RealPage. It'll give you a bountiful amount of information to help you make prudent decisions. Number four, where there's always disruption, there's always opportunity for those of us that understand the matrix and understand the data that go into making those decisions. Just because you've seen a suppression in rent rolls, just because you've seen an increase in concession, doesn't mean it's a market that you don't want to be ready to invest in. Number five, always buy for cash flow and hope for appreciation. Hope is not a strategy. The reason that a lot of syndicators are in the trouble that they're in is they only looked at their exit internal rate of return or their presumed cap rate that was what it was 3 or 4 years ago, and they're just getting hammered right now. So always buy for cash flow and hope for appreciation, and that way it's going to keep you safe in the years to come. You can also understand that if you hit this cycle right, you're going to hit it at a timing so that you'll probably have a run up in the next 3 to 4 years where your income growth will increase and your NOI will increase. And guess what? Your valuations will increase, setting you up to create better value for yourself and your investors. And the last thing that I continually harp on is be sure and become an expert at financial modeling, or know somebody that is. Either get you a great Excel spreadsheet or something like we use, like Performa Plus. There's a link below if you want to see a demo. But become proficient in financial modeling. You'll be able to make decisions quicker. It'll be more efficient and much more accurate. And once this breaks, you're going to have to do it quickly, and you're going to have to come to market with a solid foundation of whether this meets your investing criteria. So become an expert at financial modeling. Follow all of these points. Look for this opportunity to come. These disruptions are going to be great, and it's going to create generational wealth for the years to come. And you want to be there for that next run up. And believe me, it's coming, because it's historically done the same thing in the last 30 or 40 years. As always, remember, educate, evaluate, so that you can ultimately execute to increase your own personal wealth. Thanks for joining. Remember to like and subscribe. We'll see you soon.